Mortgage rates have finally taken a dip for the first time in weeks. But before you celebrate, here's what you really need to know. In a market teetering between buyer hope and economic caution, mortgage rates in the U.S. have hovered stubbornly around 7%, creating a mix of anticipation and anxiety for homebuyers, sellers, and investors alike. This recent decline in rates, though slight, is making headlines not just because it's the first drop in several weeks, but because it could signal shifting tides in a volatile housing economy. Driven by broader economic trends, including inflation control, Federal Reserve policies, and consumer spending behavior, this movement in rates reflects a complex dance between optimism and fiscal reality. The average 30-year fixed mortgage now sits just below the 7% mark, a breath of relief for some, but still far from the historic lows of recent years that spurred a buying frenzy across the country. This isn't just about numbers, it's about accessibility. High mortgage rates have been locking out first-time buyers, suppressing home sales, and freezing sellers in place due to golden handcuff low-interest loans they're unwilling to give up. And now, even with this drop, affordability remains strained, inventory is tight, and the market remains stubbornly competitive. So the question isn't just, are mortgage rates going down? It's, will they go down enough? And will it happen soon? Economists remain divided. While some see this rate drop as a temporary breather before rates rise again due to inflationary pressures or market corrections, others believe we're witnessing the early stages of a slow descent that could pick up pace by year's end. Much of this hinges on the Fed's next moves. If the Federal Reserve maintains its current stance and inflation continues to moderate, we could see mortgage rates ease further, opening doors, literally and financially, for more buyers. However, global uncertainty, debt ceiling debates, and labor market shifts could disrupt this balance. Meanwhile, real estate professionals are urging buyers to stay alert but cautious. A lower rate today doesn't always mean a better deal tomorrow. For some, now may be the right time to lock in a deal before potential rebounds. For others, waiting could mean saving thousands in the long run. What's certain is that the housing market is no longer a seller's playground or a buyer's free-for-all. It's a strategic battlefield. Understanding credit health, loan options, and timing has never been more crucial. Experts advise consulting with mortgage advisors and watching economic indicators closely. On the flip side, this is also a moment of opportunity for investors. Rental properties, multifamily units, and refinancing strategies could all benefit from even marginal rate shifts, allowing savvy players to get ahead. For existing homeowners, especially those who bought when rates were at their peak, this drop might be the first glimpse of refinancing relief in a long time. But it's not all rosy. Mortgage lenders are tightening standards, and appraisal values haven't caught up with inflation in many markets, leaving some buyers stuck between approval and reality. In this environment, information is power. Tracking the trajectory of rates, inflation indexes, and Fed announcements could help buyers, sellers, and investors plan smarter, act quicker, and avoid costly mistakes. This rate drop may be small, but in an uncertain economy, it's a signal worth watching. Whether it's a blip or the